Hi everyone. I don't think I need to mention my name. I'm the same person that I was in the last, 32 recordings or something like that. So you pretty much know who I am. If you don't know who I am, it doesn't really matter. But anyway, on this particular recording, we started talking about in the last one fiscal policies. We defined, after a little background information and recalibrating here, we found that a fiscal policy is basically the federal government um, directly affecting aggregate demand and also real levels of GDP, of course, by either increasing spending, uh, decreasing spending, increasing revenue, or decreasing revenue. Okay, and we also said that, like monetary policy, which deals with the amount of the money supply and incremental changes to the money supply, fiscal policy is used with the goal basically aimed at aggregate demand to close either recessionary gaps to kick up the economy a little bit or to kind of cool it off by, and in the process, closing an inflationary gap. So let's talk a little bit. I wanted to kind of set the stage before we um, got directly into the impacts of fiscal policies by sort of defining some of them and talking about certain measures. Now, one of the fiscal policies that is very much on people's minds is taxation. Now, how is that a fiscal policy? Well, taxation, if it increases, what it will basically do is decrease disposable income, and it will decrease business profits to a certain extent, which will um, cause aggregate demand to shift to the left, which, if they increase taxation, it's to cool off the economy. If they decrease taxation, it's to warm up the economy. So let's talk about taxation. Of course, taxation, even though people have been arguing for a flat rate tax on everything, um, and there are advantages to that, it won't happen because too many accountants and tax experts and other people have too much of a vested interest to keep things the way they are. Okay. So, gather some data here from the Federal Reserve Bank in St. Louis. They have a lot of good historical economic data. And I think it's interesting to see how um, taxation has changed over the years. Because, again, as I was saying, there's no flat tax rate for everyone. So there's different sources of revenue to the government from taxation. Different sources are taxed in different ways. Let's talk about this just a little bit here. Of course, the biggest source of revenue to the U.S. government is income tax. Okay? Income tax. Oh no, my P40 just crashed. Income tax. There is also a corporate tax. Corporate tax. There's Social Security payments. Social Security benefits, some of them are taxed. Isn't that nice? Again. Okay, we have excise tax. Excise tax is a indirect tax that's levied on companies that sell things, and they, of course, pass it on. They don't want to hoard the tax, so they pass it on to us. And other. And this isn't going to add up to 100% necessarily, but this is just the sources over the years. Let's take 1934, which is kind of sort of in the middle of the Depression there. We're sort of on the end of it. As a percentage of total federal revenue, the feds got 14% of their total revenue from individuals and income tax, 12% in corporation. Social Security was 1%. Social Security was just getting going at that point with the New Deal. Excise tax on products was about 46% of total federal revenue, and other was about 7%. Not sure what other is, but could be business tax, things like that. Now let's go to 1944. Why do I go there? Because it's right in the middle of World War II, and see how that differs. From individuals, the government got about 45%. So they're collecting more of their money from individuals. For corporations in 1944, 34%. Social Security, 8%. Excise tax on goods, 11%. Okay. And then 2% for other things. And then I moved to the 1954 and the 50s. A very good year because I was born, I guess, or a very bad year, depending on what you think there. 1954, 42% of the government's money came from our parents, or my parents and your grandparents, I guess, or great-grandparents. Let's see here. 30% came from corporations. Okay. That's 34% by the way. 34% came from corporations. 8%, about 10% came from Social Security. 14% came from excise. And about 1% or 3% there, it doesn't matter. Just two more things I wanted to see here. 1970, in the middle of inflation and the Vietnam War and all that type of things, the government got about 17, what was this here? Oh, excuse me. They got about 47% from you and I, or our parents. They got about 17% from corporations. And they got 23 from Social Security, hitting those old fogies. And payroll taxes and things like that. Excise tax, 8%. And other 5%. Now, 2018, and these are estimates, but they think they're pretty good. From income tax, the government got 50% of all their money. Okay. Corporation is down to 11%. Social Security is up to 32%. Excise tax down to 3%. And then this is at 4%. Now what can we see from this? Where is the tax burden flowing from? In 1934, most of it was on excise. Excise tax for products. Back in the Depression, only the rich people could decide to buy that stuff. So anyway, that's where it was then. In the middle of the war, it started coming out from people. And that might be a good idea in a sense because there's full employment, full production. In the 1950s, It still came mostly from people. Corporation was at 30%, 10% Social Security, 14% excise. 1970, in the middle of all that spending in the Vietnam War, almost 50% came from people in income tax. Big drop in corporate income tax, 17%. Social Security, 23%, 8% in excise. Now, currently, or last year, 50% of the government's money come from individuals. Okay, corporate profits, only 11%. Social Security, 32%. And excise tax, 3%. Excise tax, particularly on luxury things, the tax rates are going down. So what do we see from that? Well, some people argue that the tax burden is inflicted on the middle class and individuals, and there's some support for that. Okay, the corporate tax rate, the actual corporate tax rate for the United States on the books is one of the very highest in the world. Corporations are supposed to pay 35% of their profits to the government. But that's why they employ accountants, because there are loopholes, there are deductions, there are things that can be done to lower the tax burden. Accelerated measures of depreciation, which I know you study about in accounting. All those things reduce the tax burden. The actual tax contributed now, the tax rate is about 21% of corporate entities, and that includes corporations that are small corporations. Incidentally, one of the economic think tanks in Washington, D.C. did a comprehensive study of corporate taxes from the period of 2004 to, it was from 2001 to 2014. And in that time, there were 8 of the largest corporations in the country did not pay a dollar of corporate income tax. Among those being General Electric, which you may have heard of. What's another one here? Priceline, which is a large company. Pepco. Big companies don't pay income tax. The other thing that we should talk about is national debt. The national debt is the total of budget deficits less budget surpluses. The last budget surplus we had was in 2001. In fact, the 4 years of Bill Clinton all had budget surpluses. We haven't had that since. Now, a budget surplus is when the government takes in more revenue than it spends. A budget balance is when they're equal, essentially. Budget deficit is when the government spends more than it takes in. Sometimes government deficits, the budget deficits are good, like in the Depression, the New Deal. But anyway, we will talk about this subject and get really into the effect of monetary policies on aggregate demand in the next